Hi everyone, welcome to today's video. So recently you might be reading a lot of negative news around recession, that the British pound has gotten crushed, the Indian rupee is getting crushed, US is going through a recession, the entire world will go through a recession. And of course we get worried because our money is invested in the stock market. On top of that, when you hear prominent names, for example, recently Mr. Jamie Dimon, who is the CEO of JP Morgan Chase, he said that the world is going to see something worse than a recession. Then we have Mr. Charlie Munger, who said that, you know what, the markets are going to go through considerable trouble. Then every time Mr. Michael Burry goes for a nap or gets up in the morning, he makes a tweet that, you know what, we are at 50% recession, we are at 99.56% recession, the bubble is going to burst, this is going to happen, that is going to happen. Okay, lot of negative news, but let me show you a ray of hope, and this comes from a Nobel Prize winning economist. His name is Richard Thaler, and what he has said is that, you know what, the world right now is too worried about inflation, but my prediction is that the world will actually go through a deflation, and as a result we might not have a recession. So this entire topic is becoming extremely convoluted because prominent personalities, different economists, all of them are giving different viewpoints. So I thought that rather than imposing what I believe about this situation, I will just help you analyze the data. So I will talk about and help you decode what Richard Thaler exactly means. Number two, I will help you understand the constituents of a recession. There are a lot of indicators that you can track to figure out whether we are in a recession or we are about to go into a recession. So I'll help you understand those macro factors and you yourself will be able to check it out. Third, I will talk about government preparedness, that how is US, Britain, India dealing with this recessionary scenario, what steps are they taking, and finally, what are the things that you need to do in order to get rich through this recession. So this is the precise piece of conversation that we are going to have, and this video has been sponsored by Vested. It's an excellent US stock investing platform. If you still believe in the economy, if you still want to invest money in the stock markets, especially in the US stock market, you can go check out Vested. It's a wonderful platform. It's a very easy to use platform for US stock investing. I have aggregated some of my top stock picks in the US stock market. You can go and check it out. The link is in the description box. It is absolutely free. You can access this entire portfolio for free. So let us kickstart our conversation and let us first and foremost hear the commentary of Richard Thaler.
You know, inflation is the rate of change in prices as opposed to high prices. And we're certainly seeing high prices now, but let's suppose that a year from now, the war in Ukraine is over and COVID has left China. I could see deflation.
So let me very quickly decode what Mr. Richard Thaler is saying. And if you like the explanation, please do press the like button. These type of macro videos will reach out to more people and it will help them understand these concepts fundamentally. So here is what Richard Thaler means. So what he is saying is that right now there is a lot of talk about recession because there is a lot of inflation in the economy. For example, you might have seen that Feds are increasing the interest rate. Why? Because they want to control the inflation. In case you don't understand this concept, please check one of my videos. I have given an entire explanation. You can understand this point better from there. So this is point number one, that the world is facing inflationary concerns. Therefore, the interest rates are being increased by the governments, and because the governments are increasing the interest rate, therefore there will be contraction of the economy. Contraction of the economy means that the economic output will shrink. People will produce less cars, less bikes, all that stuff. And as a result, recession will happen. But here is the counter argument that has been given by him. So what he says is that, hey, people are just getting an incorrect understanding of what inflation actually means. He says that inflation is not high price rise. Inflation means the rate of change of prices, which is an absolute correct definition. And if you contextualize it to 2022, what it simply means is that, see, there has been inflationary concerns from last year onwards, and the prices of goods and commodities have been rising for the last 1 year. But this does not mean that the rate of price increase will continue to happen from this point. We might have already reached a point where this inflation has already peaked. So going forward, the rate of price increase is unlikely to happen. In fact, there will be a decrease in price increase, and therefore the world might not see inflation but would rather see deflation. Now, how does this benefit the economy in a way? It is very simple, that right now the world or governments are facing the challenge of inflation. Now next year, if they don't have to face the challenge of inflation, what is it that the governments are going to do? They are going to go on something called as quantitative easing. This is something that they did in 2008, and on various other occasions. And all of us know for a fact that whenever government undertakes quantitative easing, when it starts printing more and more money, what happens to the economy? It kind of skyrockets. So if the economy is skyrocketing, then why is there so much talk about recession right now? People are just displaying something called as lateral thinking. They are not thinking about the further steps. Now, I cannot tell you which version of the story should you believe in. Should you be in Jamie Dimon's camp or should you be in Richard Thaler's camp? That is for you to decide. But let me move on to part 2, where I can show you some of the macroeconomic indicators to outline whether or not we are in a recession or not. What is the likelihood of a recession to happen? But since this can become a highly complicated economic discussion, let me give you a parallel example. For example, if you have to prove to your doctor that you're a healthy person, what are the indicators that you will tell the doctor? You will say that, hey, my BP is in control, my sugar is in control, I am mobile. For example, I can move around my legs, hands, and my body parts are functioning well, etc., etc. And then the doctor will write on his notepad that, okay, Akshat is fit or this particular person is fit. So I hope you understand this basic example, and this is the same that we can do. We are trying to do a health diagnostics for the economy, and we are trying to figure out whether there is a recession happening and what would be the extent of that recession. So what are some of the health parameters that we will look at? So let me very quickly walk you through that prominent list. So the first data point that we could consider is the economic data. And here, one of the most prominent things we can look at is called as GDP. Now, what is GDP? Now, GDP is the combined value of goods and services that is produced within the borders of a country. For example, let's say that in 2021, India manufactured only one car and the value of that car was 1 lakh rupee. Now, this year, India is manufacturing 2 cars and the value of each car is 1 lakh rupee. Then how much has our GDP grown by? You tell me in the comment box. We have 2x'd our GDP because the total output has become 2x. This is the simple definition of GDP. And how do we conclude whether we are in a recession or not? Just by looking at GDP. So if the GDP is contracting quarter on quarter, so every 3 months a valuation is done, whether GDP is increasing, decreasing, and every quarter some kind of commentary is giving that, hey, you know what, these 3 months GDP has contracted, then another 3 months GDP has contracted. If this happens twice, then it means that the country is in recession. So this is the first health indicator. What is the second indicator? The second indicator is called as consumer price index. So consumer price index means the rate at which the prices for consumers are rising in the economy. Again, let us pick a very simple example. Let's say that you are trying to buy a scooter and this year that scooter cost 50,000 rupees. Next year that scooter is costing you 60,000 rupees. So CPI rise has been 20%. Now it would be seen that, you know what, are prices rising very, very fast? Are they rising slowly? Is it in a right range or not? So we will look at these type of things. So if you aggregate point 1 and point 2 and try to prepare a report card of the economy, you will see that GDP gets a bad grade and even the CPI gets a bad grade. So these are negative factors, and therefore some people are saying that, you know what, we might enter into a recession or we are already in a recession. Then in order to indicate the health of the economy, we can also look at industrial output or industry related data. So there are 2-3 data points. Let me quickly walk you through it. So this is called as manufacturing index and this is published in the US. We are talking about the US data because in the US we get very clean data. So here the grade is good. In terms of industrial production, again the grade is neutral. There is nothing to worry. What about retail sales? The grade is neutral. In fact, it was positive in the last quarter. It has come down a little bit. And if you look at India data, then here India, it is positive. For India, retail sales data is also positive. So if you just look at this particular part, then in economy, everything is changa and healthy. So this leads to a lot of confusion and therefore people are giving you different commentary. But what about stock market participants like Mr. Charlie Munger? So why is he worried about the market? He is looking at the stock market performance and roughly it has fallen by 20% this year and therefore it gets a bad grade. And similarly, there are bond investors and they are saying that, you know what, there is something called as yield curve inversion that has happened. So what is yield curve inversion? In simple terms, it means when the short-term returns are higher than the long-term returns, it leads to yield curve inversion. Please don't worry about it. In very easy to understand language, whenever yield curve inversion happens, it is an indicator that we are going to go in a recession. So I am explaining you all these data and fundamental points so you yourself can understand the constituent of recession. I am sure that you would not have heard about this explanation as of now. If you liked it, do press the like button. It helps these type of videos. So what is the overall report card that we are seeing? So Forbes ended up analyzing around 15 such indicators and they got to see 4 good factors, 2 neutral factors and 9 bad factors in the economy. Now you'll say that, hey, 9 bad factors versus 4 good factors, of course we are in a recession. No, it is not that simple, because these are not equal weighted. It is like saying that, you know what, one person is like extremely healthy, but that person has severe heart problems. But there is only one problem, severe heart problem. Then why is that person suffering? Because we also have to consider the severity of the situation. Now comes the second part, and this is such an important question, and I'm wondering why people are not discussing about this. And this second question is that all the data that I have shown you, can that data change going forward in the future? Because economy does not exist in a static stage. So a much better question to ask is that, hey, I have shown you all those 14, 15 indicators. Are these indicators going to change? And how easy is it for the government or the authorities in power to change this data? So let me give you one simple example to prove that point, and then I will do a quick macroeconomic analysis as to how some major countries in the world are set to change this data. So let us pick the example of GDP. So we clearly understood that GDP is what? It is the total value of goods and services that is produced within a particular country. And right now this number is negative. It is not painting a positive, healthy picture. Now what is it that the governments would want to do? Governments would want to change this number. Now how can they change this number? Again, going back to the basics, that if they simply do quantitative easing, which is increasing the flow of money in the economy, they can simply change this negative factor into a much positive factor. Can I give you an example? 100%. So example comes from 2020 COVID crisis, that in February of 2020 COVID came to India. All the economic activities stalled. There was hardly any production. Everyone said that, you know what, economic activity has stalled. Nothing will work. This, that, GDP contraction. What did the government do? Government played around with the money printing and changed the interest rate, and the stock markets skyrocketed. Even from pre-COVID level, markets gave excessive run up. So I hope you get the understanding that even if some of these factors look negative as of now, they can be turned positive very quickly by the government's actions. This brings us to the third part of the video, which is that how equipped the governments all across the world are in terms of changing these different indicators and preventing recession or preventing the extent of recession. So let me first give you some worrying data, because it is hurting a lot of nationalistic sentiments. And here is the data. Okay, so US dollar itself is performing badly. And on top of that, we have Indian currency, which is going down. British currency is just literally going to the ground. Japanese currency is further going down in the ground. So the entire world is doomed. This is literally the narrative that everyone is painting. So let us understand this viewpoint in a slightly more logical manner. Now let us first and foremost understand why the US dollar is getting weakened. Now this itself would be an entire topic. So I'll give very quick explanation. It will not be a comprehensive explanation, but it will help you understand the basics. Take a look at this particular chart, and what you will notice is that at one point in time, the interest rate in the US used to be 0.5%, and these quickly escalated to 3.5%. Please mark the word quickly escalated. So they went from 0.5% to 3.5%. And this was a dramatic change in the interest rate environment. It is like saying that you used to get 95% marks. Then suddenly next year you ended up getting 50% marks. Now, is that a sign to worry? Of course, that is a sign to worry. But on the flip side, let us understand my story, that I used to get 60% marks. Next year, I only ended up getting 58% marks. Now, is that a sign to worry? Probably not. So this steepness of change can spook any investor, and that kind of derails a currency. So therefore the US dollar is itself losing strength. But now you need to see this interest rate change in context of some history. So the history here is that for the last several years, the US dollar printing rate has been close to 14% inflation rate in the currency, which is a very fast rate. This is not official data. There was an M1 money supply aggregation and inflation rate was computed through it. So you have to take my word for it. But to cut the long story short, all of us know that, hey, the rate at which the US dollar has been printed in the world, that is absolutely crazy, and a lot of money has been printed. So when so much money is printed, there is a lot of excess liquidity. So in order to shrink that bubble size, the interest rate also need to climb up very quickly, and that is precisely what has happened. But this does not mean that next year the interest rate will continue to climb at the same rate. So I hope you got this basic information. So what is the summary of the US economy that you should know? So inflation, they are already controlling it. It is coming down in the US. They have already increased the interest rate. rate, which also means that, hey, going forward in the future, they can always cut their interest rate and bring it to 0.5%. And that will be like a bull run scenario for the market. So please understand this basic concept. Okay, now let me show you a different picture of UK. At one point in time, one British pound used to buy $3 US. And right now the situation is such that one British pound has almost become equivalent to $1 US. So what does this tells us? So this simply tells us that UK's macroeconomy is getting weaker compared to US's macroeconomy. You might have also read the news that, hey, there is very high inflation in the UK, etc., etc. Okay, so is UK taking similar steps compared to the US from an interest rate perspective? The answer is no. Here is the data to prove that point, that at one point in time, UK's interest rate used to be around 0.6%. They have only taken it to 2.3. In US's case, they had taken it to 3.5. US is shrinking the liquidity. The new Prime Minister of UK, she has not said it, but this is what her thought process is, that, hey, I have to fight the election in 2024. So I am going to increase the liquidity. How is she increasing the liquidity? This is their central banker statement, that we are going to give tax break to people. Now you think logically, that is UK shrinking the money supply in their market, or are they increasing it? The answer is that they are actually increasing it, because they are not increasing the interest rate at a fast enough pace. They are also giving tax break. So people have money in hand. It's not as if that UK will get demolished by tomorrow. So the summary statement for UK is that, hey, no matter what happens, whether the inflation become 10%, 12%, 15%, we don't care. We are going to continue to increase liquidity in the market. On top of that, we are not going to give you tax break. So therefore, commentators believe that, hey, from a long-term perspective, UK is in a bad shape. So I will just quickly plot this out so that this concept becomes clearer for you, that in the short term, the UK is not decreasing the liquidity in their market. This is what their actions tell us. In the long term, this is definitely a negative sign. This will impact the economy. How exactly will it impact the economy? So in the long term, someone needs to pay for debt. How do we pay for debt? We pay for debt through increased inflation in the market. This is option 1. Option 2 is that people will have to pay higher taxes. And whenever the country borrows, and more specifically, whenever the macroeconomics of a country weakens, it is the citizens that end up paying. That is correct. But in what time duration? The time duration for UK comes out to be fairly long, because to cut the long story short, it is still a fairly rich country, and in the long term, they will figure out how to deal with that problem. But short-term recession happening? I don't think so. Okay, final country. What about India? So here is the interest rate chart for India. And you can see that we went from roughly 4% interest rate to 5.5%. So in India, the shrinkage of economy has not happened. That's point 1. Point 2, we are still one of the fastest growing economy. In fact, we have been such a fast growing economy that some of the international rating agencies, they have changed their outlook towards India from negative to stable. So they are terming India as a stable economy. This also gets reflected into INR fall. So think about it for a minute, that India is an emerging economy. And despite being an emerging economy, our INR has only fallen by 10%. GBP, British pound, that has fallen by 25%. On top of that, we have not even contracted our economy. So this brings us to the final section as to how you can use this impending recession to make money. So this is a very famous quote from Mr. Peter Lynch, who is a legendary investor. And he said that people lose a lot more money waiting for the stock market crash than they lose in the stock market crash itself. I still know people who are waiting for Nifty to go back to 7,500 levels. Why? Because during COVID, the markets had fell from 12,000 to 7,500. Now they want the markets to go back to 7,500, and they will not invest unless the market goes to 7,500. You let me know in the comment box, is that going to happen? So point-wise format as to how you can use recession to make money. Number 1, please invest. Is there risk? Yes, there is risk. There is volatility. Whenever you are investing in the stock market, you have to go through that volatility period. No one can guess right whether the markets are going to fall tomorrow, day after. There are some geniuses who keep on commenting. I posted a video 2 days back giving a long-term view that, hey, markets are going to rise. Then they are creating ruckus that, hey, you are wrong about market because the market fell today. If you are that type of an investor, please stay away from the stock market if you are in the habit of tracking your portfolio every single day. You are not an investor, you are a trader. When you are a trader, please use technical analysis, technical targets, and figure out your entry and exit points accordingly. So point number 1 is please invest. Point number 2 is please hedge. So hedging means that, for example, buy some defensive stocks, buy some aggressive stocks. Defensive and aggressive, let me give you an example. Hindustan Unilever is a defensive stock. Right now, the FMCG companies are giving massive profits. In November, December, these stocks were trading at a massive discount. On the flip side, right now, growth stocks, for example, a classic case in point will be TCS. That is trading at a discount. Now, it might very well happen that in the next 6 months, the growth stocks are going to give you massive run up, but the defensive stocks are not going to give you run up. As an investor, you should be prepared for both type of markets and you should hedge your portfolio. By the way, this is not an investment advice. Please use your rationale. I'm just giving you logical information. Third and final point, please do not buy overinflated assets. For example, right now, a lot of assets are deeply undervalued and a lot of assets are deeply overvalued. Which specific things are overvalued, undervalued? I will probably make a separate video or we'll talk about it in the member section of YouTube. So you can go check it out. But please understand that do not purchase overinflated stuff because we are still in a sideways market, and my hypothesis is that whether recession happens, a deep recession happens, all that stuff, we would continue to be in a sideways market. But I also know that markets are going to give a breakout. When exactly, 3 months, 6 months, that no one knows, but you have to stay invested in order to make money in the stock market, and you will only catch a breakout when you are invested. So the summary of the video is that please take a little bit of short-term pain in order to see long-term gains. Thank you so much for watching, and I'll see you soon.